how risk controls are applied before capital moves. In institutional digital asset management, risk is addressed before execution, not after. Post-trade corrections cannot reliably prevent loss in fast-moving programmable markets. Capital protection depends on pre-trade risk controls embedded directly into execution workflows. Pre-trade discipline ensures that exposure aligns with governance, compliance standards, and portfolio strategy before capital ever leaves custody. What pre-trade risk controls do. Pre-trade risk controls act as upstream safeguards. They prevent oversized allocations, unauthorized transfers, exposure limit breaches, counterparty misalignment. Unlike post-trade reviews, these controls intervene before a transaction is confirmed. Capital moves only when it satisfies predefined operational criteria. Core elements of pre-trade risk discipline. Effective pre-trade controls include transaction validation. Every order is checked against exposure limits, portfolio guidelines, and risk thresholds. Counterparty and venue verification. Platforms and addresses are validated before execution to reduce execution and settlement risk. Policy enforcement. Internal governance rules are embedded into trading systems, so non-compliant transactions cannot proceed. Automated escalation alerts. Trades exceeding limits are flagged for review before capital is exposed. Each layer reinforces discipline. Why upstream controls matter in digital asset markets. Digital asset markets are volatile and continuously active. Incorrect wallet addresses, misconfigured smart contracts, or liquidity gaps can result in irreversible loss within seconds. Pre-trade controls convert operational risk from reactive remediation into preventive governance. The objective is not faster execution, it is controlled execution. Digital asset compliance as a control layer. Digital asset compliance strengthens pre-trade discipline. Pre-trade validation creates audit trails documenting who authorized the transaction, which limits were checked, what controls were applied. Segregated accounts, exposure verification, and governance thresholds ensure operational integrity. Compliance embedded at the point of execution reinforces investor capital protection. Integrating pre-trade controls into governance. Effective operational risk management requires alignment between governance and execution. Institutions define risk appetite, exposure thresholds, approval hierarchies, escalation pathways. When these parameters are embedded into pre-trade workflows, capital moves only within established boundaries. Discipline becomes operational, not theoretical. Why post-trade checks are insufficient. Post-trade detection is reactive. By the time an error is identified, capital may already be exposed or unrecoverable. Pre-trade controls shift focus upstream, minimizing operational incidents before they occur. In volatile markets, prevention preserves capital more reliably than correction. Kenson Investments helps institutions design and implement structured pre-trade frameworks for institutional digital assets. If your organization values prevention over remediation, clarity begins before capital moves. Visit kensoninvestments.com and connect with a digital asset specialist.